Hi everyone. Welcome to our Open the Box webinar with Paolo Sironi here. Thanks for joining. I'm going to wait a few minutes to give everyone a chance to join, and then we'll get started with our introductions.
Paolo Sironi. Not Sireni.
All right. I will I will already start with a poll here for those who are waiting. So we have a little bit of a conversation starter here. We're wondering how you feel about AI and the future of banking jobs. So is AI coming for bankers' jobs? Feel free to answer to the poll while we're waiting. And I think, yeah, maybe in 1 or 2 minutes we'll get started. But I see people are already joining as well. Some interesting answers already, Paolo.
Yes, what's the feeling? Yes.
Yeah, so,
It's not that simple.
yeah. Okay, so it's evening out a little bit more already between it's not that simple and yes. Okay, so we're at 50-50. Interested to see where we go in the end.
We can wait.
Yeah. Okay. It's good to get a temperature. Not a lot of no's, none actually, to be precise. So it's good to see where everyone is with their feeling about AI in banking, and I'm sure we'll address your views on this matter throughout the webinar, Paolo.
Of course. Then banking is fairly diverse industry. There's many jobs and activities done by bankers.
Yeah. Okay. So we're at 11:03. I suggest we get started. Feel free to still answer the poll, but we're going to go ahead with our introductions at least. So I'm honored to be welcoming Paolo Sironi here from IBM. Paolo, I suggest you go ahead with the introductions, with your own introduction here.
Okay, so I introduce myself, Paolo Sironi. I do a variety of things. Professionally speaking, I'm the global research leader in banking and financial markets for the IBM Institute for Business Value. The title is as long as a book. So the IBM Institute for Business Value is the IBM research center that attempts to connect the dots between business and technology, because technology for technology doesn't generate value. Of course, it's the business application of tech that makes more or less sense. Then on top of this one, or on the side, I'm also book author. I have 5 books out there on a variety of topics related to financial services. Now, I was born as a quantitative risk manager. For almost 15 years, I was leading market and counterparty credit risk in capital markets. And no surprise, my first book is the probabilistic scenario optimization. So it's innovation in quantitative finance. Then I moved to Germany in 2008 to build a small fintech dedicated to digital wealth management. So no surprise, my second book is the fintech innovation, from robo-advisors to goal-based investing and gamification. When I start delving into what I believe is the most relevant generator of potential value in financial services, that is the advisory or planning relationship. Then, of course, when you talk about banking, you need to consider regulation. So my third book is the MiFID II, Value Generation for Investors, which is about European regulation, the MiFID II, but it has been widely read worldwide because the MiFID II is very complex. It's like New York, where you make it there, you make it everywhere. So it's an interesting perspective. And it starts addressing the question, what is value? Because if we do not identify value, we cannot digitalize value. Or we can also say, if we define value correctly, we might not be able to digitalize it the way that AI pretends to do. So is on one side, it allows you to extract value from digital, if you define it correctly. On the other side, it protects the people value, right? Because you define it in a proper way with the client. So then I thought I needed a fourth book that is the financial market transparency theory and principles. We might delve into this in a moment. I'm now deep in IBM, so I joined IBM in 2013 when IBM bought my fintech, and I think that the change required by banks in the era of AI are like changing the way we produce electricity. So you want to move from a carbon plant to a nuclear plant. Wouldn't you change the theory underneath? And so we need a new theory, a new economic theory, which is theory of openness and theory of transparency. That's why I wrote the FMT, the Financial Market Transparency Theory Principles. And I really feel like many bankers are not making the ends meet with the digital transformation because they're still applying technology on a faulted theory, which is the one that created the global financial crisis, and we're still entrenched into that one because the quantitative easing and the central bank intervention allow the bankers to buy time, but bankers didn't use their time wisely to rethink their business models. And that's when finally I condensed everything into the Banks and Fintech on Platform Economies, contextual and conscious banking, where I try to reconnect all these dots in a way that I do answer the question, what is the business model that makes sense going forward in financial services? Because many people brag about that. They say, you need to change the business model, and then they don't define it. And hear me well here, digital is not a business model. A business model is a business model when you define how people get motivated to pay for your services, for the good and for the bad. And so that's basically the essence of my literature. Then, to conclude, I also engage the communities worldwide, and not just because I travel continuously to meet clients and the ecosystem, but I also run a podcast at the Bankers Bookshelf, which has been going on for a couple of years. I've been podcasting for at least 5, but this format was born 2 years ago. And that's about a monthly schedule where I identify interesting books or research papers. And I get the authors or the researchers to join me online to have a conversation like this one, which is centered on my literature, because I think it's more interesting than the blah, 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 to hear from people that spend time researching or investigating. We can agree, disagree, but definitely is a different way of enriching our perspective. And then, of course, is an opportunity for people to get the books, spend their time reading, read. People don't read anymore. Study. People don't study anymore. Without this, it's impossible to change our mindset and therefore identify new ways of leveraging technology that are not based on fortune, chance, but are based on thinking.
Okay, nice. So thank you, Paolo, again for joining. I think this proves why we wanted you as a guest here. I'm going to stop the poll. I think we have some really interesting results here. One I'm not sure, and one no. The others seem well. A lot of people think AI is coming for bankers' jobs, and then quite a few not that simple. So I'm going to stop the interaction now. Then for my introduction, I'm Jona. I'm the Chief Revenue Officer at openthebox. What do? We provide real-time insights for faster financial decisions. So for the age where people don't read anymore. Openthebox tries to fill that
with
gap by providing the key insights really quickly. So at least the things you still read are the most important things about the market, about companies and entrepreneurs. We let companies identify credit and market risks easily. We provide custom analytics for banking portfolios and easy dashboards for internal and regulatory collaboration. We also have a little surprise here. Paolo showed his book. It's an even better shirt than the one we have on this slide that he showed you earlier. But we're giving away 3 copies of Banks and Fintechs on Platform Economies, Paolo's bestseller, for people that stick around until the M&A. So definitely make sure to hang around with us until the end to get one of those copies. All right, let's dive into the actual content of the webinar then. So I think Paolo, roughly speaking, you've described a lot of these key transformations in banking. I think roughly speaking, we can say that we've been going from an originally branch first approach in banking throughout the years. We've then been moving into digital up until the platform. I wouldn't say that all of those transformations are necessarily complete, but right now, even though we're still going through some of these previous transformations, roughly speaking, the AI first era has definitely arrived. Some have entered this new era, I think, more fully than others. But what's your take on this evolution? Is this how you see roughly everything going now?
Yes, with some caveats. I like, first of all, the bumps in the road because it's like a moment of understanding and realization. And by the way, I have a 6th co-authored book that has been published 3 weeks ago that is called Branch Tomorrow. So very interesting because together with Brad King, we re-edited his original book of 10 years ago with new data points. That's co-authored with Efi Pilarino, with Richard Sorin, Bruno Dinitz, and Jim Marous. And we reflect on the fact that the branch peak is past. So now it's like the number of branches worldwide is much less compared to the one that we had like 10, 15 years ago, everywhere in the world. Though in some parts, like in India or in China, banks are still opening branches. But the trend is that you need a mix of these things, right? You need the branch, but not so many as in the past, and the branch needs to do something else. So it's a reflection about the economic model of branches and the economic model of digital. Because what happens is that effectively, when the financial crisis started, though in some countries like in the UK, the trend started before, it was easy to think I cut costs by reducing the branch network. And people were started moving on websites and now on mobile apps. So it was also convenient for the bankers to believe that it could engage clients without having to spend all that money on the real estate. However, a problem materialized getting towards the digital, that relationships were lost. So I call this first period the branch first transformation, a digitalization to core. So banks just wanted to rebuild their infrastructure, like going on cloud, because they need to connect to clients on websites or mobile apps. But what happens is that a lot of revenues require people talking to people for a few reasons that we might discuss in this webinar, which are at the core of my financial market transparency theory and the Banks and Fintech on Platform Economies. And so that is where banks started actually to use AI. So the usage of AI starts with digital to personalize the relationship. So now a lot of interactions are on digital app. More than 70% of clients prefer to use digital to do the basic transactions worldwide, and the majority use the mobile app. But then they need to receive notifications to be invited to do more, right? So that's when the mobile app moved from being a checking opportunity of your account into an opportunity to get services like buying a credit card or a short-term loan. But still, that was not enough. And the reason is because a notification is not communication. So it might work for things which are very simple, where clients can self-direct themselves, what I call clients can pull, okay? While most of the clients can pull. So the thing that I discuss in literature and research is that the mobile technology, whether it's an Apple or a Samsung, is a technology they demand. So people don't go on Amazon to see what happens. They go there because they want to buy one of my books. And I tell you guys, you can get 3 free copies by Jona, so don't have to do that. But most of the revenues in banking are operated as an offer-oriented economy. Think about wealth management or bank assurance. The clearest example, but it happens also in the credit space in quite a number of cases. And so how do you put a communication, an offer-oriented business onto demand-driven technology? And that's where platforms starts helping in reducing the distance between the pull and the push with a variety of ways. And identify the two. One is contextual banking. So the moment you make yourself available in the place at the time of the need, the distance between being capable of pulling or being willing to be pushed, reduces. So your digital power is enhanced because it is right where the need is felt, right? But that still is not complete in the picture because it will not really work for everything. You still have a communication element. And that's when you move from using AI for turbocharging your marketing bazooka, if you like, at the very beginning notification that has that much of a capability into addressing the communication element, which is clear now thinking about generative AI, which is a language model in many cases. And it's not only that, right, but in many cases. So that's when we see that on the platform economies, but only if they're well designed and considered, you can now basically bridge the gap between pull and push and start generating more revenues. But you cannot pretend to lift and shift your business model and operate it on a platform and then hope that AI will do the job for you. That's not going to happen. So the picture is AI taking our jobs is not that easy because it depends on what we're talking about. So more like into that answer myself. The more the business model is transparent, the more you can do with technology. But the more at the same time you need people to do with technology to reach out to people. It's like a funny thing, like the two things following each other. But what matters is that you can effectively differentiate in front of client to generate that new value that needs to be the core. So I hope I give you the perspective and then we can deep dive into what is that value, therefore how AI interacts with the generation of that value, where it can maybe replace with more automation, where it can instead integrate the relationship with people to make sure that people are motivated to interact and are willing to pay for the services. So again, it's about the value for money. Who can crack the code of the value for money, can scale it, right, and shield from competition.
All right. Yeah, I think that makes perfect sense. And there's going to be more in-depth discussion, I think, of more concrete discussion about how that actually can look in practice. I think so. You've already touched upon this. So we've got the platform banking. I think there's a lot about the contextual and the conscious in there. For those who haven't been exposed to these concepts from Paolo, maybe you could give a short introduction on how you see these concepts. But I think in general, how do you see this platform banking evolving into this contextual and conscious banking with AI? Based on your quadrant. I think the devil's advocate question would be that we are probably able to do a lot more contextual work. With AI, we can understand a lot more about the client. We can become a lot more relevant. But I'm interested to hear your take.
So for those who haven't had the chance, so at the core of this work, there is the Banking Reinvention Quadrant, which has two dimensions. One is the information quotient, and the other one is the communication quotient. When you intensify the information quotient, you go more towards contextualization. That means opening the core banking to reposition the data, commingle with other data inside open ecosystems, where you see the behavior of people, the interactions among the parties. You use AI and most likely cloud or public cloud technology to be relevant in the now, in the place where that is needed. And then you have instead the communication quotient, which is the one that needs to scale a relationship which is very complex and communication without, of course, that's my take, abusing of the relationship, which could be the fear of missing out or elements like this one. So we have to identify exactly what is the value of banking. So the fake belief in the asymmetry of information. We go back to university here because there's a problem there to be resolved to understand that to the conscious banking. And why do you use the word consciousness? I know that people may be like frowning a little bit. I remember years ago, I was starting discussing these topics using the term the knowledge digitalization or the knowledge digitization. And I did that because I thought it was more approachable as a concept. But I don't like the idea of knowledge per se because data is always incomplete. Even in the contextualization, there's an element which is missing, which is part of the relationship. And I remember when I made a presentation on my second book at Wharton Business School, a guy raised his hand and said, why do you talk about knowledge? You should talk about awareness, right? To generate value. And I said, not even. I said, because awareness is like, or actually said wisdom, said wisdom. And I said, wisdom is like, you learn from the past, and now you have it because you're an elderly person, they have wisdom, right? But in reality, everyone is facing uncertainty, even the wisdom person, right? The person with wisdom. So consciousness is really about accepting the fact that the future is open. So now, essentially, banking is an industry where few people pretend to know too much about the future. They know nothing. You can have local, temporal arbitrage opportunities, but we really don't know what happens in financial markets in the end. And the majority of people believe they don't know anything about the future, but they know enough to be sober, okay? And use the data for what it is, right? An indication, but not the truth. And it requires consciousness, essentially, about the fact that uncertainty is a structure. And that's essential because the more uncertainty there is in the process, the more it's difficult to digitalize it with technology. The more AI takes uncertainty out of the discussion, the more AI can replace the relationship. The more AI adds uncertainty, because it can happen, because it is unstable technology, the more people distance themselves. Okay, so you damage the digital relationship. So in the end, you understand that this is the core concept that designs the way you use AI technology into contextualization and conscious banking to move forward. But then, as you try to intensify the information quotient, let's say machine learning, as you try to intensify the communication quotient to simplify, let's say, large language models or generative AI, you can start moving, on both sides, so in the diagonal. And then you find interesting business spaces or also conceptualizations. On the business side, I provide examples about banking for small and medium enterprises, knowing that small entrepreneurs require advanced contextualization. They have no time to go to the bank to do their things. Okay, they have to focus on their business, but also need relationships. One of the most important data points of my research last year with the World Bank on small and medium enterprise banking is that asking entrepreneurs what they need from their bank to be successful, the most important data point was financial advice and advice for business planning, okay? So they need that because there is also two reasons for this. One, because sometimes it's difficult to make the decision, but the other one is also entrepreneurs know that if I ask the bank for 10, 20 million euros, okay, for a loan or a mortgage, they're certainly believing in their, entrepreneurial idea, but they know something can go wrong. So implicitly, you need to also always understand what's playing in the background. They want to talk to a banker because they believe that if something goes wrong, but the banker bought their idea, the bank will help them to stay the course and move forward. Instead, if the banker is not there, they fear that if something goes wrong, the bank will not care, just ask for the money back. They kind of structure it that way. So it's like a risk management of their entrepreneurial motivation by making the plan together with a banker. So you see the two are starting to get there. So you need an element of conscious banking, which is a transparent advisory platform, and you need an element of contextualization because as much as possible, they want to do this seamlessly at the moment of need, right? While they're doing their job. So in the evening, without having to go to the bank, during the day, because they're busy in doing that. And that's the beauty of the quadrant that allows you to identify your own path towards the generation of our business value, some starting from contextualization, some starting from the advisory perspective, but then in the end, if you want to strike the best and the most, the two are basically mixing and converging. And that awareness from a business perspective informs decision-making process in the technology as well, because while you're building technology, you just don't build technology for technology. Of course, there are parameters, there are others, but you need to know what you need it for, right? So you can justify the investment or deploy the investments through time in a very strategic way, which is not like just random or following the latest buzzword or trend.
Yeah, I think I hear in there a reconstruction of what it means to be relevant as a banker today to these entrepreneurial clients, be it in corporate banking or the small and medium enterprises, also for wealth clients, private banking clients. Essentially, the more context you have and the more aware you are of the timing, the more relevant you are as a banker, the more you can provide that value at the right time. And I think it, as you say, I think we see this a lot with our open the box clients. Is there is an expectation of entrepreneurs and any in any banking relationship today to move away the burden of informing the bank on the context. A burden is more and more expected to be taken up by the bank. And at the same time, people are also managing larger portfolios today than they often would have in the past, where these kinds of systems that can allow you to have this context at your fingertips, that really makes the difference and makes banks relevant in the longer term.
Let's give a couple of examples here, right? So to ground it down, of course, data is important. What I'm saying, however, is that data-driven banking or data-driven financial services must be preceded by data-enabling clients, because you have in front of yourself a client that, for the vast majority, is concerned to make a decision facing uncertainty, because deep inside there, they know the future is uncertain, right? So it requires a lot of like a buy Bitcoin. Then they get seduced by the fact that, I didn't buy that, I have to, right? Maybe it's the right timing, because you are invited to go beyond your constraints, okay, facing uncertainty. And doesn't mean that you do not have to consider uncertainty. The point is, you need to be aware that uncertainty exists, but consciously make a decision that you want to move forward using some data that inform the way that you have to make it. Okay.
Yes.
And so that is the core. So that means that when you recognize that the asymmetry of information is a make-believe, so it's not that really bankers have more information to get the exact decision. You position the data in a way that is way more sober and substantiated, but you need a space for doing that. So what is the space that allow people to use the data to be enabled is planning, typically. So I've been researching on methods that allow you to create a planning perspective where financial decisions are positioned as an integration of liabilities. So a financial decision is buying assets. It can be a financial asset like a treasury, it can be a digital asset like whatever else on the fine. But you always do it because you have liabilities to match, right? So you have aspirations, you have children, you have a loan to repay, you have an enterprise to develop. Now, here is the thing. The personalization does not occur at the level of the assets. Forget the idea that assets personalize, Jona. Assets are all laying on the same fundamental uncertainty, and most likely the main drivers are always the same interest rate risks or the same corporate volatility and estimates. But the contextualization occurs when you have the full view or an enriched view of the liabilities of that individual. And therefore, you start projecting over time what that person might feel like is important for him or for her in terms of personal financial life or business life. And then you try to bring in financial opportunities or financial risks to be managed in order to create that specific personalized individual journey. Now, in most of the cases, there is a siloed perspective in wealth or financial management where you create a risk profile which is really abstract from the aspirations of the person. And every person has multiple aspirations, which means multiple time horizons, which means multiple risk profiles. And it's the realization of that that enables you to build a platform for financial advice that contextualize into the liabilities while bringing you opportunities to communicate financial, if you like, risks that you want to manage or financial opportunities that you want to bring inside in a way that you differentiate and create stickiness. And then, according to how you do it, the monetization of that will be positioned one way or another way. There are better ways than others to be capable of succeeding in digital. Maybe we have time to discuss this as well, right? But that's basically the way you bring the two and the way you bring data, recognizing the fundamental uncertainty underlying. So the symmetry information is not true, some may believe. The clients buy because of some point trust, but then creating that value really on a planning perspective, the data that you want to use to give to the client make way more sense, right? And they're consumed with more clarity. So there will be bumps in the market, and what happens often is that when the bump occurs, clients get dissatisfied, they move out, they're upset. While instead, if they're conscious about the effort that they made on the platform with the banker to do that, you gauge also the volatility of the client and not just the volatility of the market. So you need to put both of them together. So that's when the business model makes sense across the market cycle. And I know that some of the young guys that are attending this conversation might not be fully aware of that because the last 10 years the central bank has pumped so much money into the market that made us live in a spatial bubble. And we don't know how long that bubble will continue and will hold, right? But even though being aware of that is important to make resilient financial decisions.
Okay. Yeah, I think that makes sense. And it ties us up, or it sets us up, I think, for the next chapter in this discussion. So I think by now we more or less have an idea of your opinion here, or it's we can read it between the lines. But I think there are several ways that AI can go. You also we know that AI projects and core banking projects can often go wrong. But do you see it as a threat or an opportunity for contextual conscious banking and conscious banking to have AI as a tool here, really? And I think in this context, mostly really for empowering the banker in the front lines, especially within their relationship.
Is a threat if you do not understand the truth of your business model and the client relationships. Is an opportunity if you understand that and you can leverage it. I'll give you an example.
Yeah.
I was talking to the CEO of a very prominent private bank some years ago. He asked me for the conversation when he saw my literature. And he said, Paolo, I am the best research center in the world. I can tell Jona there is a stock in Liechtenstein you should buy, but I cannot sell it because of compliance. I don't know why you cannot buy Liechtenstein stocks, okay? But it's an example. Yeah. So everybody goes, oh, compliance. And then he said, this is the reason why I ask you for this conversation, because if I make my clients 100, only 30% read my research. He said he is the best research center in the world, so his value proposition. And only 10% understand it. So he goes, can I use AI to digitalize the research so that is 30% to read and it understand it? And I'm like, yeah, but you're losing the remaining 70%. Yeah. And so I don't quite get it. And the reason is because Of course, his value was primarily tax arbitrage, but you don't brag about it on the Financial Times, right? Fair enough, I understand that. But there's another reason why clients buy those products. My father used to buy funds whose prospectus of information was in English. My father never spoke English. When I asked him, Dad, why do you do this? He goes, oh, there might be somebody in the city of London, smart people, making these decisions. It's in English, right? So, and I'm like, yeah, no, really, right? So the fact that make believe that through research, the future is a make believe, but the client doesn't really understand what you're talking about, because sometimes bankers talk about nothing. So the point is exactly this one. If you believe that that is your value, research, what happened, and you tell your client, what I was told recently by another CEO of a bank is that clients now, I think it was, go on ChatGPT, put the portfolio information, okay, and the data that they are given by the private bankers about their investments, and ask ChatGPT what they think about that. And when they go in front of the private banker for a monthly review, that's where they start from. Say, hey, I asked ChatGPT, to comment about your ideas. This is what it said. So all of a sudden, people feel empowered just because ChatGPT tells them something that is an hallucination anyway, because ChatGPT does not know. And therefore, the banker is exposed because, you're operating to say here. So that's not really the real value anyway, right? But when instead you ground your business model on hyper transparency, that means you eliminate all the conflict of interest. You're clear of the fact that you're just trying to scout opportunities which are not the truth, but is an attempt. That changes the tone of the conversation. Right? But clearly, if you do that, you need to figure out how to empower the client still to trust while you're not using language which is seductive language. And that's where you need technology and AI to help you reorganize that conversation in the right way to support that one where ChatGPT is not capable of, intersecting or competing because it's not grounded. You see what I'm saying? And I can see that clearly in the way you can apply. So if you stay within a model based on the fake perception of the symptom information, that model commoditizes. And you already see it, like you think about investment management, the vanguardization. So the embedded fees on ETFs now is almost zero, right? In the US. Now it's not the same in Europe because regulations still did not allow the competition to occur. The MiFID II was not perfect. In the Netherlands, you have the banner retrocession, so the model is more advisory. In Italy, you don't have that, so still you have the highest embedded fees in financial products compared to other European countries. But the moment that continues and the commoditization occurs, if you stay in the business model, you can be replaced because you don't really have the hooking point with the client. Instead, if you understand what really goes on and you empower advisory to be operated at the level of the relationship and you need technology to engage with the client at scale, then it becomes an opportunity, not a threat, right? But you need to shift the business model from a brokerage to a not advisory, transparent advisory method. And there are other things that we can discuss here in terms of how to embed transparently business strategy. And maybe for the next question, I don't know which one is it, but we can wait a moment.
Yeah, so I think we have a lot of things here, but it essentially just again comes down to how you deploy this AI on top of your research, how you empower your bankers with it, and also for bankers themselves, how they use AI. So I think, roughly speaking, probably AI is not coming for the individual banker or the value adding banker their jobs necessarily. It's not necessarily a threat. It's how you leverage it as a bank in your business model, how you let it turn research into advice and opportunities for your clients.
Now, yes, I'm like everything, there are tasks that can be more automated, right? Now, the point that I'm making also in IBM research is that technology being more powerful is also more unstable. It goes, with saying if you want more flexibility can also be a risk, right? So it's the risk management perspective that enables you to manage more powerful technology being more unstable in a meaningful way. But it also means that the real business value doesn't come from automation or the simplicity if you cannot be uber scale, right? But somewhere else. So is the opportunity to understand how to use AI to reshuffle as Sangeet Chodari would say, the operating model in an institution. That is the one that unlocks most of the value, where you see your institution as a platform itself, because you have different people and stakeholders operating at the same time. They require consensus. So that is to me the most intriguing and interesting perspective, which is difficult to be realized because the way banks, like a lot of corporate, deploy resources and investments is very siloed. They all look for that use case. And by trying to work on that use case, they might do a couple of things. Either constrain themselves, they get a little advantage immediately, but they can scale, or damage themselves because they reach up themselves into different technology stacks without realizing that doesn't enable to create, if you like, a cross-department consensus and interaction. Instead, if you can have that strategic perspective at first, the investment will be very different. Maybe it doesn't seem so easy and so immediate, rewarding, but you know that it took like 7-8 years to the new bank to be profitable, but now Nubank is the most profitable new bank in the world. 32% return on equity, 30% cost income ratio, 130 million customers. Of course, they didn't get the value in 1 year. For 1, 2, 3, 4 years, they were losing money, but now they were there. So you as a banker as well needs to be aware about that fact that transformation doesn't happen overnight. So if you chase for the low-hanging fruit, you will not get the juicy fruits, okay? And that is unfortunately what I see happening. So my attempt and work in literature, inviting people to study for long-term strategies and enriching continuously with IBM research, is a call for the board, for the CEOs, to get a different understanding with their CIOs about what it really means to transform with AI, so that instead of seeing it as a threat, that can give some immediate advantage, but then in the end corners you into a commodity that doesn't really generate value that you can use to remunerate stakeholders and shareholders. You can then see it as an opportunity, but it's a Copernican change in the way you look at the problem. And it is hard to see that happening because the constraints inside the organizations are big. So it starts from the top, doesn't start from the bottom. Sorry, guys. Otherwise, it's innovation theater.
Yeah. Okay. Fully agree. And I think that ties us up perfectly for our final here. So how ready do you see most banks are today across the organization? You've touched upon institutions being siloed, long-term view. I think we also see this in the market. There is a lot of, I think, looking at AI as the goal, not necessarily the means. Today in this whole transformation, a bit of fear of missing out, sometimes also in what they want to tell their shareholders that they are doing. Which kind of risks do you see concretely for banks, for bankers, for teams, the whole organization in moving into this new AI first future?
2 years ago, I started saying that as much as every banker is a risk manager, every banker must be an AI risk manager going forward. Okay. And why do I say that? If you ask me which is the bank that can lead the pack in the AI transformation, I tell you it's the one with the most deliberate risk management. I was talking with the CEO of one of the top 5 European banks some time back this year, and asked what prevents your bank to scale AI enterprise-wise, so you go from experimenting into scaling to transform. And he said, well, it's the chief risk officer, not because I don't like the guy, but he said, the fact is that I have hundreds of cases in front of me, some live, some ready to go. We now play with multimodality and generative AI, and we're thinking agentic AI. If you look at generative AI models, they deprecate every 3 to 6 months. There's a new OpenAI model every 3 months, right? So it takes 9 months to do the validation. So you have to restart, by the time you finish, you have to restart again. So we have to reconsider the way we build the platform to develop, test, and deploy in production. And the organization, on top of this perspective, that needs to reconcile. That's not easy because that was not thought at the very beginning. I've been advocating for this for a while, right? But, again, you start from the low-hanging fruit at the use case. So that is the point. The biggest risk is to misunderstand the risk management. Yeah. And it's not about ethics. I love the discussion, of course, it's important, but that can be very abstract. You need to ground it instead into tools, into measurement, into reporting that allows the CEO to take action. We interviewed as IBM Institute for Business Value 300 CEOs of banks worldwide, asking how much risk they are willing to take to get advantages of automation and competitiveness with AI, and 66% said that they must take significant risk. So they got the point, but someone needs to answer, okay, that realization, and it takes some time to do that. And so I'm seeing now some institutions getting down the path to start those conversations across the border between the first line of defense and the second line of defense to create that framework that enables them to get the comfort. Still, there will be another step, which is the business intentionality, maybe another conversation that needs to be realized. But embedding business intentionality, think about agentic AI inside the system, can be done only if you have a risk management perspective that holds and you understand how to transform your business model with hyper transparency. So then I close the circle again, right? So I see it as the technology evolves, as much the theoretical foundations become more and more relevant, because of course they've been thought through, right? And that's what I'm discussing when I can with the C-suite.
All right. So I think again, because this is our final chapter for today, and then we're going to jump into our Q&A. I think we can conclude that there is a lot of opportunity with AI to be ready for the future, be even more relevant for clients. There are risks in getting there, and things to watch out for, mitigating risk management, as you say. I think also implementing it well
is really managing, right? Not just mitigating, it's really managing. The word management has meaning, right? So it's not to be scared, but to have the capability to manage.
Yeah. All right. Okay. So I think that's a good conclusion for our discussion for today. We before we jump into the Q&A, I want to give everyone here a quick reminder that we're also running a survey on AI readiness in the Belgian financial services industry. Make sure to fill out our survey. What we'll do is everyone who participates will get an individualized report benchmarking your answers to the rest of the industry. I'll show this slide again at the very end. But before we conclude our webinar for today, I want to jump into Q&A. So if there are any questions for Paolo here that you want to ask about your individual journey as a banker going through this huge transformation in the sector, anything else, maybe you've already read the book and you want you have a concrete question, feel free to go ahead. We'll now open the Q&A, so you can ask it in the Q&A section or in the chat, and we'll handle your question immediately.
Sounds very good. Well, people are thinking there's no one size fits all, right? But there are foundational pillars that apply everywhere, and distinguishing these two elements is essential.
Yes.
What's good for you only and what is essential for everyone.
All right. We're also running a poll here on where you see the AI readiness of the industry. So if you don't have an immediate question, feel free to answer the poll, and otherwise, feel free to ask us your any questions you might have, especially if you have any questions on this AI readiness. Make sure to take advantage of Paolo's presence here. You don't get him on an interview.
While waiting, let me tell you something. The real technical depth of the world economy is Excel. Only when Microsoft will stop selling Excel licenses, not using AI to create an Excel spreadsheet, but stop selling those licenses means AI took over the world. Okay.
Yeah.
So technology is there's a bit. I mean, it's powerful, but bit of an emphasis, right, which is unnecessary.
Yeah. All right. We have a question here. So first of all, maybe Ben, who would like to meet you at the Singapore FinTech Festival
Oh,
next month. Not really a question, but he left his email here as well. And I have Johannes, who says, Jona mentioned that the context will not be coming from the client in the future, but that it will be more a responsibility from the bank. How do you see this happening in practice? You hint to sources as KBO, Belgian Gazette. How would this work in personal banking? So where does that context come from? Maybe I'll jump in real quick and say, Johannes, this is something that we do for a lot of banks. So we provide that context. So I think it comes down to data sources, smart selection, governance, and how you have the AI process that. Would you agree, Paolo?
I can give you an example, which is actually written in my research last year on small and medium enterprise banking, as I bring to the surface also conversation with key bankers and ask them for an edited version of those discussions. And there is one of the head of commercial banking of Nubank, the largest new banking award in retail, and now is expanding SME banking. So I had a bank in Europe who told me that 20% of the clients gave them open banking consent. Now, the more consent you have, the more data you have, the more understanding of the context you have. And the bank said that they want to basically tell the client that giving consent allows them to give them a better price, treating the client as an old client of theirs. So that would be good, which is okay, but it's like discussing the price outright, right? So I'm not going to give you a good thing, but if you do something for me, I give you a good thing. It's okay, but you see the implication of that. The guide law is written in our voice makers. He said, well, no, I want to demonstrate to the client that banking with us makes them more successful. So the motivation to give consent is to really get something back, data enable the client. You see what I'm trying to say here?
Mm-hmm.
If you want to data drive your bank, and they proved very successful because they launched these solutions with that conceptualization this year, and they grew a lot. They started going. So that's an example here on the fact that to create a context might not come from the client, but we need to give the client to access their context, right? So you need to
Yeah.
always ask yourself. So, so while the money that banks typically make is in that context interest rate margins, when you think this way, interest rate margins are a buy side because you enable the client with services to give you because they get, and then when they need, they're there and they can ask for something, right? They're already in front of you, whether they're on your app or you're in their like ecosystem. It can be different strategies, but it's the same concept here. So it does work. But it requires to define your KPIs as a business differently from a traditional bank. And if you still define your digital KPIs like you would do in a traditional bank, I'm sorry, you're not going to build something that differentiates and stands out, that creates stickiness for a lower cost, where client retention and client acquisition are seamless. That means very cheap, and then it will end up into extra costs. So the cost of serve will remain high. Digital will not generate the same revenues because you need to commoditize on the price because they're competing on pricing, and so and so and so forth becomes a threat because you're commoditizing, right? So that business intentionality at the very beginning is strategic, and that makes a hell of a lot of a difference at the end of the digital journey.
Yeah. So I hope that answers your question, Johannes. So
And for
providing
Singapore, yeah, and for
yes,
the festival, unfortunately, I believe I'm not going. I'm primarily in Europe and in Latin America in the month of November. I've been going there a few years. Once I managed the full stage on financial inclusion and education. So I hope you enjoy. It's a nice conference, but I may not be able
yeah.
to attend.
All right. Maybe maybe Ben will be able to follow up later on. So I have yeah, Johannes here says it was a very insightful answer. Then I have Guillaume here who is asking, is the latency of banks to adopt AI giving some rogue bankers the excuse or opportunity to do these things anyway on their own without risk oversight of the bank? And is this not actually a greater risk?
Okay, so I guess what you're saying is shadow AI, right? So the fact that The bank might be building the framework. It takes time, and in the meantime, people start using it. That's always a risk. Like here, you can also get inspired by the research we published as IBM Institute for Business Value in May, the risk management of AI with AI, where we also brought a conversation again, actually, with Nubank. So we have the Chief Risk Officer of Nubank, Carabante, and the head of AI products and strategy, Philippe Lamourmier, talking with Juliana Simao, who is the head of risk management of AI, always at Nubank. And they discussed basically this issue, right? So sometimes banks started prioritizing key aspects, leaving that space consciously for using AI as a productivity tool. That means you may have a copilot or another. And the reason is actually that it's very difficult to control everything. If you control everything, right, you cannot go to the very end. But that doesn't make people that want to use AI this way necessarily rag bankers. I think when you say rag banker, maybe it's something else. I'm not sure if you just use the word provocatively, or you really think about something doing with a mischief, perspective. So I believe like that is more like the convenience that makes them use it without thinking too much. But that is the point of the cultural perspective. So when every banker is an areas manager and the culture transformation is in that direction, even though you have some loopholes or you have more space for action somewhere compared to somewhere else, your risk can be more mitigated, right? Because everybody's a bit more aware, right? If you don't build that one instead, and you pretend everybody to be like rigorous, that also, of course, creates a crack in the system, because you may not control fully, but at least you want to make sure that you ring fence it with a cultural perspective and a good education. Interesting, some banks, for example, here I saw that from the top, they create a lot of educational opportunities to understand more. And also understand more means understand what it means that the large language model hallucinates. Here again, we are not discussing the problem in the right way. It is the nature of AI to hallucinate. Why? Because it doesn't know. It doesn't know. So until we treat hallucination like an extreme event, we don't get it. Once we understand that the framework is uncertain because it does hallucinate by default, because it pretends to know, though it conveys a good answer, but it doesn't really know. Already, we're using it with more skepticism than this, so we can extract the real value we want, right? But promoting the non-hallucinating AI as if it is, right, it gives this false perspective that the tool is aware effectively of many things, and instead of being an ally, is something like could replace that conscious decision-making process. So it can accelerate that in some cases with caveats. It can strike right to the center, knowing that sometimes it can go damage, but that even when it goes to the center, it is not because it's aware of being at the center, right? And then changes completely the way you look at this, and allows a lot of people to use it with more cautiousness. That means generating the value that sticks and not the one that deprecates.
Yeah. So I think in conclusion here, so Guillaume indeed meant mischievous by rogue. I think we can conclude that for banks to adopt these things effectively, governance or education of the people will be very important, and also the quality of any kind of vendor data sources and the way the AI is trained.
All of this creates quality, but education not on how to use it, but what AI really is.
Yes.
Start from that, because some start in teaching you how to use it, but they do not discuss truly what AI really is and how it uses data. And without that piece, you miss a leg.
Yeah, I think it's important for organizations to reframe what it means to be an expert in this age, so that it's not just the AI telling you what to do, but the expert still needs to know how to frame the information that is getting from it, and turn it into actual advice or decisions. Okay, we've reached 12 p.m. So this is our cue for wrapping up the webinar. I think first of all, I want to thank Paolo massively for being here with us and providing all of this value. I want to thank everyone here for joining us today. We'll pick 3 people who stuck around randomly and give you a copy of Paolo's excellent book. I'll remind you one last time about our survey. So yeah, again, one last time, thank you everyone for being here. I've also been told just now that we have a wrong a wrong URL in this slide. Apparently, the correct link is in the chat right now, so you can actually just click it and go to the survey. But I think that concludes it for today. And then I thank you all for being here today. Thank you, Paolo.
Grazie mille.
All right. Goodbye, guys, and see you on the next one.